Well, that's a tough one to accept, isn't it? That's a tough one to accept. I suppose if we look at it from a slightly bigger perspective, one of the things we can start to recognize is that any time we get the dollar index going bid, because oil prices are higher, anytime the dollar index goes bid with these high oil prices, we could be seen to be moving into a reflationary environment, because with oil prices at a way up here or a way up here or currently still relatively high, we could obviously start thinking about that any dollar bid, regardless of the impact it has on oil, any dollar bid could be seen as a reflationary theme. But obviously, if that dollar bid has a collapsing value in oil, then of course I don't quite agree with the reflationary theme. But here's the point, guys. Just because Reuters say it, or just because Bloomberg say it, or just because Goldman Sachs say it, doesn't mean it's true. It just means that that's their opinion. You guys are perfectly entitled to have a different opinion, so long as you can verify from what you're seeing. So let's carry on with what they said. The reflationary themes at play amid the latest surge in copper and iron ore prices. So let's put the copper price on the charts and let's see what they are talking about here, because obviously we've just got oil prices on their own. If we put the copper price on the charts, this is what they're suggesting is the reason why it's a reflationary theme, because the copper price has been soaring over the course of this period here. Now, there's a lot of agriculturals that are soaring as well. There's a lot of, now I can't remember which agricultural, was it corn or wheat, or one of the ags was really rocking this morning as well. I'll put on corn just out of curiosity to see what the corn price is doing. And you can see that the ags are getting absolutely rocketing to the upside. And therefore, we do have an element of reflationary coming in, haven't we? That is so aggressive compared to a dollar which is static. That puts you into a reflationary theme right there. Now, a lot of people will look at that reflationary theme and then realize why the gold price, for example, sold off so hard and fast today. Because who's going to have a bit of trouble when there's a big reflationary market showing up? Well, gold may have trouble, because that's going to be a possible problem for higher price gold, isn't it? So we can see obviously that weakness in gold getting a little bit of sell side pressure today. That was that $1,000 trade that we called earlier. So there is a bit of a reflationary theme driving in the markets, but reflationary themes obviously lead to bond prices dropping, not rising, as we go through the morning session. And obviously we got the overnight sell on bonds anyway, and we made a lot of money on it. But that overnight theme changed here, when the dollar started to rally kind of into this 7, 8, 9 o'clock area here. We started to see the dollar finding buyers, showing up into the low prints here. The copper prices, the agricultural prices had no effect of that dollar rally coming on through that phase. And obviously that puts you into a reflationary mode right through the London session, and therefore into the US Open. So with the approaching US supply coming in, reflationary themes at play amid the latest surge in copper prices, those selling pressures accelerated into the European and US handover as the US belly led yields higher ahead of the 2s 5s auction today. So let's think about what they're talking about. The US belly led yields higher. So let's just put the yields on the charts so that we can understand what they're thinking about here. So there's the US 10-year yield. And we can take a look at the storyline of the US 10s, and we can obviously look at it from the perspective of the belly of the curve. So we'll put the US 10-year minus the US 5-year. So when we put the US 10-year minus the 5-year, let's take a look at this US 10-year, 5-year relationship. Let's get rid of the dollar index for a second, and let's change one of the colors so that at least you can see what the damn thing looks like. Okay, so let's understand this relationship a little bit better. the belly is the orange line. Okay, so the belly is the orange line. And obviously one would imagine that the belly should always be, the ability that with the belly should always be that it directs the traffic of the 10-year yields, shouldn't it? So this is a question that we try and answer, isn't it? We try and answer whether the belly does direct yields higher or lower. When the belly leads, we can start recognizing that the yield at higher prices does have a far harder job of moving higher. No shit, Sherlock. Why would that be the case? Because if the belly's narrowing and the yield's higher, what's happening to the absolutes? Well, the absolutes are getting squeezed out of existence, aren't they? If the yield goes higher and the belly's dropping against that, that's going to squeeze the absolutes out of existence. So we can obviously understand that that has to be relieved a little bit with the 10-year yield starting to drop back off of those narratives. Pretty simple stuff, really. So when the belly of the curve again starts to squeeze against a yield that's now making higher highs, what's happening to the absolutes? Exactly the same as what happened to the absolutes the last time. The absolutes are getting murdered as this goes higher, and that's going to drive the yields lower. As the belly leads the curve again here, you can see what happens here when the yield goes higher. The absolutes are getting squeezed out of existence. And as a result, this is likely to be a sell trade coming into this narrative. What happens when the yield is improving? The curve is improving, sorry, and the yield is dropping. And there is an awful lot of room available for the yield to move off the lows, correct? Does everybody agree with that storyline about the belly leading the yield? Is that a normal storyline that you guys can get behind? So what about today's market? What about today's market? Well, I can't agree with it today because it didn't lead, did it? If anything, the belly led this yield lower, not higher. The belly of the curve was subdued as the yield rallied through the overnight session on the short bond that we had from last night's tweets. So as the yield rallied, I mean, obviously the belly did go back up in line with that. Of course, everybody can say, well, the belly did lead if we zoom down into a lower time frame. But there's also a macro context to this. Let's take it down into the 5-minute chart. Did the belly lead into the US session open? That's the question that they were asking. Well, yes. Let's be honest about it. The belly was giving us a little bit of a look, and we could see the yield was obviously lagging just that little bit behind the belly of the curve through this phase here, maybe even through this phase here. So on a micro picture, the belly certainly did seem to lead the curve higher through that phase. Into the top edge, we start seeing the belly running out of space and the yield running out into an area that it can't survive. And then we had a little bit of a problem here, which resulted in the belly collapsing, not the yield rising. And that's obviously this little storyline that developed into this area here, where it's all moving off the fives. So does the belly always lead? No, but does it usually lead? Yes. Should the belly be executed on a longer term chart basis? Yes. Have we made money on it regardless? Yes. Have we managed to sell some bonds off the top edge? Yes. Have we made some money? Yes. Does it make sense? Yes. Because the belly is obviously now at a premium to yields on this short-term view of the London session. You know, we can see if I just take some samples from the London Open from the just before the break, we can see the belly is only just a wee bit lower, whereas you can see from the yield is quite significantly lower. So the belly is obviously slightly premiumed against the yield, and as a result, we would expect the yield to be rising. And as a result, we would expect to see bonds falling. That's exactly what's happening as the bond is starting to fall off the high price here. It's dropped off that high print that we were trading into. So we're finally getting a good response to that short bond trade, aren't we? So we can accept some of this, can't we? The weaker than expected March durable goods print saw yields drop from their highs, bringing the curve unchanged into the New York cash equity open. Well, that's what we talked about, the weaker than expected durable goods prints. Obviously, that came in at 130. We can obviously see the impact that the weaker numbers came in at 130. There's the 130 print there, and that's obviously going to drive bonds against the fundamental backdrop of that weaker print. So we're happy with that. We understand that. Looking ahead, including Tuesday's 7-year auction, corporate supply, FOMC on Wednesday, US GDP on Thursday, and PCE price index numbers on Friday. Furthermore, month-end flows will again gain more than just lip service, particularly as auction supply passes, although given that it's not been a refunding month for the Treasury, UBS sees duration extension of a relatively modest 0.07 years, typically on non-refunding months due to increased index turnover. Non-refunding, obviously there's different kinds of bond auctions. There's the refunding auctions, there's the non-refunding auctions, but the technicality is minor in this case. The bank sees a chunky 0.19 year extension for TIPS because of the TIPS April 22 dropping off the index. Technically, yields remain in similar ranges to last week, with the 10s adding support at 1.6% ahead of last week's 1.63% peak. Now, that's obviously just looking at the yield itself, which obviously is very important to us as bond traders. We always want to know where the yield max highs and max lows are. Bears will be looking for a breakout of the peaks seen back in early April, March. Part of the retracement lower in yields since then has been attributed to Japanese purchases since their new fiscal year, although recent MOF data shows purchases losing momentum, so Japan not buying as many US Treasuries. A recent survey of Japanese lifers, a key market cohort, we know the Japanese lifers, obviously these are the big buyers of US Treasuries, showed mixed feelings for foreign bonds, when some said that they would hold off on aggressive purchases of US sovereigns due to the risk of another selling route, the potential return of funding pressures, currency hedge costs, and potential currency volatility. Some actually expressed the increased allure of JGBs. As yields on JGBs have started to rise, some people have started to buy into that storyline. Some insurers even expressed interest in moving out of the credit spectrum altogether to get a pickup in yield. Goldman Sachs suggests that whilst they see some Japanese insurer demand for foreign sovereign bonds, in aggregate these plans suggest flows are unlikely to be unusually large or persistent. So basically they're saying that there's going to be potential problems with supply coming into the markets. Well, we're going to find out soon enough with the auctions this afternoon, but they're saying that the Japanese are not as interested in the US Treasuries at this point, and they're more interested in the JGBs. So that's interesting as well, isn't it? We can start watching for those weaker demands in the auctions. We want to be making sure that there are some concessions building. If there's no concessions, we want to do a bit of business. We want to do a bit of business. And that's what we're doing. We're currently short bonds, as you know, from 19s, and we're doing a bit of business. All good?